Now, so far we have seen the definition and the basics of volume analysis and how it relates to price movements and open interest movements. Now let's take a step further into volume and using volume for your analysis in technical charting, and we'll look at the types of volume indicators. But before we talk about volume indicators, let's first talk about some of the basic principles, general principles of volume analysis. They're not very difficult to understand or comprehend. They're more of a common sense most piece. So first is high volume movements confirm the trend and low volume movements contradict the trend. So in other words, if an uptrend or a downtrend is supported by high volume, which is the other word or proxy for a number of market participants believing in that price movement, then we know that the trend is supported or confirmed. On the other hand, if the volume is low, and high and low are relative terms, we are going to consider high and low as higher than average and lower than average, average volume being general volume or average volume over a typical trading day, right? So if we have high volume, that means more market participants are of the view that the trend is in the right direction, and we'll see that the trend is confirmed. On the other hand, if it is followed by low volume, then we can see that even though the prices are moving in a particular direction, prices are trending, the number of market participants who have conviction in this price movement or if of this direction is lower. So we see the trend is being contradicted with low volume. Next principles are volume declines in consolidation patterns. By consolidation, we know the price phases or patterns where prices move sideways, right? In a box pattern or a rectangle pattern where prices are not moving in a particular direction, they're not trending, but rather moving sideways. So volume declines. The side effect of this or another implication of this volume relationship with consolidation pattern is the prices are stabilized, right? Fewer and fewer market participants believe or rather are aware or have an opinion about the price movements, so the transactions are not very high and we see the volume declining in the consolidation phase. The longer the consolidation phase, the more prominent is the decline. And this consolidation phase, when it ends and the volume new price trend is started either on the uptrend or on a downtrend, for example in our rectangle patterns, right, there is a consolidation phase, prices move in a particular resistance and support band, and then they move up or down, that they emerge up or down based on when or in which direction the breakout happens. So when the breakout happens, the volume will spike, but during the sideways movement within the rectangle pattern, the volumes will be lower and declining, right? So that's the first set of principles. Then the expectation from volume indicators is there are two critical ways in which volume indicators could be used to deduce some information. First is volume indicators should lead the prices, and that is something that will be supported by patterns as well. Second is volume indicators should confirm prices. Again, it goes back to these four principles. Now, if there is a trend that is expected to happen, then we'll see the volume indicators, volume would be higher. So the volume will confirm, the volume spike will confirm and rather lead here the new price trend. But in case of a consolidation phase, the volume indicators volume would be decreasing. So it will confirm the trend or confirm the sideways movement, consolidation phase in this case. Same happens with uptrend and downtrend as well, when they change either to sideways movement or to opposite movement. So this is the way volume indicators should help us make decisions. Now we'll look at some of the common volume indicators. There are 7 common volume indicators We'll just look at them, we'll classify them based on type, but obviously not all 7 indicators are important equally, nor from practical or charting perspective, and neither from exam perspective. So we'll just get a brief look at what are these 7 types of volume indicators, and we'll move on to look at the indicators which are really the most important and most commonly used volume indicators. So the types are first being pure volume. So this is volume rate change. We see that volume bars, which are pure volume indicators. Then we have volume accumulation. So this is on balance volume. How much volume is being traded on balance, or rather on open markets. Then we have volume accumulation based on intraday movements. This is Chaikin's money flow index. We'll look at it in detail in a graphical form. We also have volume price range indicators, which indicates the example being ease of movements indicator. We have price accumulation based on volume change, which is positive volume index. We have tick volume indicator, which is an example being money flow indicators, and we have volume adjusted price indicators, which is money flow index. Now obviously we don't need to study all of these indicators in great depth. We just need to know what are the basic types of volume indicators from exam perspective and even from practical perspective when it comes to application. Some of the indicators have a very niche and specific use, so we don't use them in practical application, in usual application. Only specific uses are being used, and that too when they are supported by other types of indicators. So we'll not study those, we'll just go through them briefly, and we'll look at 2 indicators in greater detail, which are money flow index and Chaikin's money flow. The name may be similar, but they decipher, they interpret different information. So let's look at them graphically. Now let's look at a typical graph. This is my price chart. Again, it's very similar to what we had in the earlier slides, earlier discussion. These are my volume bars below this, and I am trying to understand how I'm trying to relate what would be the volume indicators and how they will help me. So I'll be looking at 2 indicators. First is money flow index, and next would be Chaikin's money flow. So let's look at the money flow index. Now money flow index is actually a momentum indicator that measures the flow of money into and out of security over a specific period of time. It is very closely related to relative strength index or RSI, but additional part being volume. Right, so RSI considers only price movements. Money flow index takes it one notch up and includes volume into RSI. So it is calculated by adjusting for or accounting for positive and negative money flow values and calculating a ratio of positive and negative money flow values. Right, in RSI we only have positive and negative price movements. Here we have money flow volume weighted prices to arrive at a money ratio, and that gives us an money flow index. So you'll notice the values, the chart or the scale here being between 80 and 20, right? 20 and 80, this range, and this is also highlighted here. Now this is the average range or usual range of this indicator or this oscillator. If my prices are below 20, then I can call this as my oversold zone. If my value of MFI or money flow indicator is above 80, then I can call this as an overbought zone. The prices have moved up a bit, or prices are overbought, so they may reverse or they may correct rather. And so we see the prices have increased drastically in this short span, and that is supported by the MFI value being above 80 in the overbought zone. And obviously the values may change temporarily based on market conditions and higher volatility, and that also these levels, just because it's an overbought zone like this here, doesn't mean that these are buy or sell signals. The prices, I mean, if you had gone by general understanding and overbought, meaning the prices would reverse or at least correct in the near future, so I can sell the securities here, then that's not true. The prices have increased further here. The implication here is that the trades here have been supported by higher volume, right? Whereas trades in this region have been supported by lower volume. That's all. And so obviously this indicator, money flow indicator, has to be supported and contradicted depending upon the situation by additional indicators and additional patterns. During strong trends like this, it is common to have money flow indicator MFI to be in the overbought or oversold zone. It is also quite common to see the MFI value being closer to one of the ranges, closer to 80 or 20, of course within this zone for an extended period of time. So just because the value is above or beyond this zone doesn't mean that it's a buy or sell signal. For that we have to get it supported by some other value. Now this is the money flow index MFI. Another concept, another volume indicator is the check-ins money flow, commonly known as CMF. Now it is usually calculated over a period of 20 or 21 days. Now you would see this parameter here, 20, right? 20,0. That means it's calculated over 20 days. It's basically a volume weighted average of accumulation and distribution, which is buying and selling of securities over a specific period. Again, the principle behind CMF is that closing price is nearer to the day high, more accumulation has taken place, right? And if the closing price is closer to the day's low, then more distribution has taken place. By accumulation, we mean more people buying the shares, net positive or net long positions. Distribution means more people selling or offloading the shares, and net selling has happened. Obviously, these are relative terms. When a transaction happens, there has to be equal number of buyers and sellers. Otherwise, the transaction cannot happen. The general consensus or general idea behind looking at this CMF, or what we mean by accumulation, is more people have accumulated this stock or security near higher prices, which is the higher closing price. Or when this happens when the closing price is closer to the day's low, it means fewer people have taken new positions, but they have rather closed their positions. So that's the general indication or general use of CMF. Again, it does not give us buy or sell signal. It has to be substantiated and supported by other indicators. Now, if the price action is consistently closing above bar's midpoint, that is to say, if the price is consistently closing towards or closer to day's high rather than day's low, that's why my price or day's close is closer to high. So for example, here actually this position, the open is not relevant, so let me take it out. Now if you notice, this close is more closer to or more towards the day's high rather than day's close, so it's in the upper half. So if that is happening consistently, and that too on increasing volume, that means the CMF value would be positive, right? So the range here is, the midpoint is around 0, so we have plus 0.2 and minus 0.2, that is the usual range, but of course it can go, it can take higher values like we have seen here. It is closer to 0.4, which is almost twice the usual CMF value. And obviously we can see it in this range, right? Even MFI is on the overbought zone, it's on the higher side. So what it basically means is, in this range, the day's close is more towards day's high, right? The bar close is towards on the upper half of the bar consistently, right? Here you see these green points, the wick is smaller, right? In case of candlestick, what we can see is the wick is smaller, the bar is on the green side, which is indicates its close is on the higher side than the open, and the wick is smaller. So what In this case, the CMF value would be positive, above 0. And we've seen it here. And if we look at this particular region, we see the wick on the upper side is smaller than the wick on the lower side. See, for example, here, 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 and the close is on the negative region. Generally, the red bars are more than the green bars, so the close is on the negative region in general. So here we see CMF value being below 0. So basically the 0 line is strength of market. If the value is above this dotted line, the 0 line, the CMF is on the plus side of CMF value. That means the market is strong. If it is on the lower side, on the negative side, then it means the market is weak, it is indecisive, and often trading sideways. So what we have to do, how we can use CMF, is we have to wait for CMF indicator to confirm a breakout and breakout of the direction. Confirm the actual breakout and the direction of the breakout based on price action. So when we have a trend line here, or if we draw this trend line to confirm if the breakout has really happened, we have to support it by CMF indicator. If price breaks upwards through the resistance, like it has happened here, right? This is the resistance and price is broken here upwards. If this happens, then we have to wait for CMF to have positive value to confirm the breakout direction. So to be sure that this breakout on the upside is sustainable and stable, we have to wait for the CMF value to be above this dotted line or above 0 to confirm the direction. This has not happened. It happened only here at this point. So, and that too for a brief period of time. So that means this breakout was not a very strong breakout. Right? And we have seen this, even though the prices were higher for a period of time, they gradually lowered, they gradually came down and even retraced. They not only broke this support, the resistance, which later turned into support, but also went down. So that's why we can see, like, until and unless the CMF value supporting this breakout on the upside, we cannot say that the breakout is true. In this region, however, we see the breakout has happened. So if we trace, actually, let me just draw a very rough support and resistance zone. Actually, it would be something like this. Now we would see that this resistance, after it was broken, became the new support, but this obviously was not supported by the money flow or the volume. In other words, it broke, it reached down, but then when in this phase, when the breakout happened, it was also supported by positive volume or the positive value of CMF indicator. So we see that this value or this particular breakout is more sustainable and more stable. Took support here and it has jumped up again. So it has stayed above this new support line. This was a resistance line here. After it breakout, it became the new support line. It has stayed above this support line for a consistent period of time. And it is also supported by this CMF value being on the positive side. So it is helping us confirm the direction of breakout. This is how we will use these money flow indicators or check-ins money flow value to confirm a trend or a breakout in a particular direction. So this is how we will use indicators in general, in broader terms. They do not give us a price target. They do not give us a stop loss target or a price. They have to be combined with other indicators to get the best outcome, a conviction out of our particular trade. Now we are going to look at a concept which is basically a recap, or rather a background, prelude to something that we've seen before, right? We've seen short-term patterns before. Now, one of the short-term patterns that we saw was candlestick pattern, or candlestick patterns rather. Names of these patterns are very peculiar, but you remember the candlesticks as a concept, as a visual representation of open, close, high and low prices was very, very appealing. It was very contrasting to the daily bars in the sense that you could get a sense of market sentiments very clearly even within the trend through the red and the blue or the filled and non-filled bar. So this chapter, what we're going to consider is candlestick. So we're going to look at candlestick charting essentials. Not a very big chapter as such, right? It's just the basic of what we have covered already. Now, before talking about candlesticks, I would like to talk about this term, Mokari Maka. As you can see, this is not an English term. It's actually Japanese for, which roughly translates to English as, are you making a profit? Now, why are we talking about this particular Japanese term, Mokari Maka? That is because candlestick as a pattern or candlestick as a technique was developed around 300 years ago, around 1700s in Japan through the rice merchants, right? So this term was coined in Osaka, where the merchants used to greet each other with this term, asking if you've made profit or if are you making a profit. So having given that background, that's not an important background, right? This is just a interesting piece of information. But what is important about candles or candlesticks, as they are called, is they are very reliable, rather more reliable than the bar graph, right? Bar charts. They are also early indicators, early signals. They give signal early and more effective. At the same time, better visual signal, right? Because you have colored and uncolored bars, you can see where the daily open and close were with respect to highs and lows. The charts, the wicks or tails as they are called, can give us relative position of highs and lows for the day, right? So the candles are usually more relevant. Now, one of the reasons why candlestick pattern is more important and makes more sense is because in shorter time frames, the fundamental factors are less important, but more important factor is the psychological component of the market or market participants as a whole. So the way to measure the emotional aspect of the market is through technical analysis and specifically through candlesticks. Now, bar can also give us the same information, but candlesticks give us the information in a better way, in a better visual way. And at the same time, the patterns that can be used through candlesticks are also more reliable and give the indications, give the market trend bit earlier than the bar graph or line graphs. Now, another important aspect about using candlesticks is we know that the patterns or rather movements are fractals, right? So whether you take daily movement chart over 5 years period or minute by minute trades chart over 1 day period, the patterns are going to be exactly identical. You will not be able to distinguish between a daily pattern or an hourly pattern with a daily pattern or a minute by minute pattern. And that's the idea of fractals. So if in a shorter time period, if you see the open has been such that the trend is supposed to be reversing or there are signals that a trend is reversing, then you don't need to wait till the end of the day to get the bar chart or the candlestick for the whole day. You can look at hourly trade data and analyze the hourly candlesticks rather than daily candlesticks. It will give you the same information but a bit earlier. That's the idea of fractals, and candlesticks are very important, very convenient tool to do that. So what they help us do is they don't only help us gauge the events, market events, but also human reactions. Human actions that cause them and human reactions that are caused because of them can also be used through candle charts. One point that we have to keep in mind that candle charts or candlestick patterns do not offer price targets, right? So that is a very challenging part of candlestick patterns. They tell us whether when the trend is reversing, they tell us when trend is being followed or when it is extending, but they do not tell us what is the price target. So you can have entry point, but you'll probably not have the exit point. You'll not have the you'll have the stop loss point, but you will not have a target price. So in that case, you may enter a trade thinking you're in a trend, the trend is being followed, and there is a breakout and you enter a trend. That it could happen that this particular trend ends right after you enter, and there is not much profit potential in the trade in the first place. So it wasn't worth entering into that trade. So in that case, what happens is you would rather support candlestick patterns by other patterns, bar charts, or any other patterns that you may have with volume supports to get some price targets, to get some information about estimated profits and stop loss if your estimated profits from the trade are substantially higher than the risk of failure. So the probability of profit is substantially higher than the probability of failure, then it makes sense to enter into trade. And that information is not given to us by candles, but it has to be derived by linking and pairing candlestick patterns with some other types of patterns. So that is about price targets by candlestick patterns. Now, another interesting point about candlesticks or candles is that if a candle signal confirms a support line, it would increase the potential bullish implication of that candle signal more than if that candle signal did not confirm the support. In other words, if we see a support or resistance line, which is the trend line as well, which is often called out by a straight line. So if candle pattern reiterates or reconfirms that support or resistance line, then we see there is higher potential, right? Either on the bullish side or on the bearish side. So if candle confirms a support line, we see a candle reversal near the support line. Then that is a bullish implication. And at the same time, if we see a candle reversal near resistance line, then that's a bearish support. So if we have to visualize it, suppose this is my resistance line and these are my candles. So if my reversal happens like this, right, it goes to support, it goes to resistance and then reverses, this gives me a bearish implication, bearish signal, and a strong bearish signal. The only idea here being is the candlesticks also help us reiterate support and resistance lines, and also when they change their polarity. The change of polarity is a small concept we've seen before. What it means is basically when a target line, so either support or resistance line, is breached, then that line becomes a new resistance line. So if this is a resistance line for example, if this pattern, right, breaks out, right, this goes like this, breaks out till here, then next time when there is a decline, this resistance line will become the support line, new support line. That is called as change of polarity. So resistance becoming support and support becoming resistance is called as change of polarity. Now let's look at some of the candlesticks and get an idea about how to read them. You've seen the patterns emerging from candlesticks already. So this concept is not new. All we have to do is look at the important concept just to reiterate what we know already, and that should be enough. So this is how a typical candlestick looks like. This is the body of the candle. This is the wick, upper wick. This is the lower wick. And the body may be colored or light depending upon where the position of close and open is. So in this case, the body is light, which means that this has been an uptrend. So the day's low is, so day's open is somewhere here and day's close is somewhere here. So the close is above the open, right? Open is here, close is here. Price has increased between the day, close is higher than the open. That means overall the price has increased. That's why this candle is lightly colored or unfilled. If the close was below, right, in this case for example, if this was the close, this was the open, the close price was below the open price, then this was a negative pattern, or this was a bearish day, the price has dropped overall. So the candle here, the body of the candle is filled, these are the day highs. These two wicks are day highs, and these two wicks at the bottom are lowest prices. It's the length of the wick tells us how much the movement has been. So obviously, when we see here, this distance between top wick at the end of top wick and uh, bottom wick is much greater than what we see here. This is the range, trading range for the day. So we can say the volatility has been higher. So body of the candlestick gives us a visual representation of the volatility for the day. Length of wick also as an indicator for that. Color gives us the overall movement in a day, and color of the body or length of body gives us the movement between the difference between open and close for the day. It doesn't have to be these candlesticks are the same from interpretation perspective. It's just that in some cases a higher close would be denoted as unfilled, where a lower close will be denoted as a filled triangle. Here, red denotes when the prices have dropped, the close has been lower, and either blue or green denotes when the price at the close has been higher than the open. So we can have this kind of pair, filled and unfilled, or white and dark, white and gray. We can have this kind of pair to denote up or down, or a higher close or lower close, which is red and blue, or it could be red and green. And this tails or wicks or shadows could be relatively higher or lower. Now, higher the or longer the body, larger has been the movement. There are also patterns where we see the body is very small, but the wicks are very long, or compared to the length of these wicks or shadows or ends, the body is very small. So it would look something like this, right? This is the body, but the length of wicks or length of shadows is very high. The body could be filled or unfilled, red or green, whichever pattern it is, whichever color combination we are using. What it tells is this particular shape or this particular situation is called as a doji. I'll just write it down, D-O-J-I. What doji denotes is the movement during the day has been very high, but the market has somewhere reached equilibrium near the end of the day. The close price and the open price have been very close to each other. Basically, it means that market is in temporary equilibrium, but there is also high volatility. So there is price discovery that is happening here. There could be a breakout happening soon, right? Either on the upside or downside, and we may see large candle body in next couple of trading days. If this doji pattern is observed for many days, it's a signal of sideways or neutral trading, and that's a very uncertain area. Right? We are not the market overall does not have a direction as to which forces, bullish or bearish, are stronger, and it may break out soon. The pattern may reverse soon. The trend may reverse soon. So that's about candlesticks and the essential concepts about it. We have seen the patterns already, so we'll just understand this theory and move on to our next chapter. Now we are going to look at interesting charting techniques or charting patterns, which is called as point and figure charting. Now, for those of us who have never been introduced to technical analysis before, point and figure charting is totally going to be appear new. It's going to appear random, but there is an order within the randomness, as I can call it. Those of us who have been into technical analysis for a while will be familiar with the point and figure charts. But if this is the first time for you, then this might appear to be totally random and confusing to you, especially the rules of how the point and figure chart is drawn. But it is totally worth understanding it. One, because it gives lots and lots of information. It is defined by very simple rules and well-defined trading systems once you understand them, but it is not being followed by a lot of technical analyst technicians. Right? Even most of the websites will not be able to give you point and figure charting for the data. Right? So let's get started with these. There are certain characteristics of point and figure charting. Again, as I said, these are trading rules for point and figure charting are very simple and well defined. So we don't have to look for too many complicated patterns. There are only 7 or 8 uh, s- large patterns or main patterns. Rest of them can be derived and or could be mirrored on the downside. So whatever pattern is found on the upside can also be mirrored on the downside, but basically there are 7 or 8 patterns only, not more than that. So that way it is straightforward and it's easy to remember. Now next part is that it ignores price movements or reversals below a minimum price movement or a tick size or a box size. So box size determines what would be my minimum price movement or a tick size. And any price changes below less than that tick size will be ignored totally. Right? For example, my box size is $1 and if the price changes by 90 cents, I will not consider that as a part of my box or as a part of my movement, and I'll not add it to point and figure chart. Another interesting aspect is it does not have a time factor, right? So it has no relation whatsoever with the time factor. You can be using movements. So again, as I said, the movements are based on value. So if our box size is fixed as $1, if the price stays within the range, it changes for less than $1 for 2 days straight, then there will not be no new box added for 2 days. Obviously, we'll change the size of the box based on our volatility of the market. If the volatility is high, the box size would be higher. If instead of $1, we'll consider price movement like $2 or even $5 in some cases. But if volatility is low, then our box size or tick size would also be proportionately lower. It could be as low as 10 cents also in some cases, depending upon the price. So this basically our charting is dependent on the movement or volatility or the daily or intraday movements of the prices, not the time frame. So it could happen that we find too many boxes getting formed, new boxes getting formed in a single day, or we could have no new boxes formed in a matter of couple of days. And at that moment, we will have to reconsider the size of our boxes, the tick sizes that we are considering, right? But that's slightly different issue. We'll come to that later. Now, it also assumes that the markets have strong, efficient hypothesis. So it assumes that the markets are strongly efficient because it takes for granted, this method takes for granted that the price of a stock at any point of time or any given time is the correct valuation. So there is no mispricing happening. The pricing is correct. The valuation is reflected correctly in the price of the stock at any point of time. So any trade that is happening, any buy or sell trade that is happening is first of all consensus of opinion of all the buyers and traders in the market at that point of time, and also influenced by the forces, all the forces governing the laws and supply. So it basically, in other words, assuming that the markets are efficient or strongly efficient, there are no market anomalies, and there is no gap in the information flow. Right? So that's one of the assumptions of this method. Another assumption is the last price of the stock, or rather current price of the stock, any way you want to see it, reflects everything that is known. So all the information in the market, private, public, internal, company internal, material, non-material information is reflected in the pricing at that point of time. So again, it's another way of saying that the markets are efficient in this sense. And another important aspect, which is slightly different from the efficient market hypothesis, is that the trades that are happening, they are also reflective of the future movements or expectation. In other words, that any observer of the market cannot conceal their future intentions regarding it. Right? So if that observer of the market participant is entering into a trade, if he or she is entering into a buy side of the trade, then they are expecting the prices to increase in the future. We're not talking about time frame here, right? The time factor is eliminated, so it is going to increase in the future. That's what we know. If they are selling, then they are they are expecting the prices to decrease. If they do not enter in a trade, right, that's also an behavior. Either you buy or sell, or you do not trade at all. That means they expect the price to remain in their range for a considerable point of time. So that's why they are not entering into a new position. So these assumptions is something that make this point and figure charting unique. And as I said, they ignore the passage of time. It doesn't matter how many hours or minutes or days have passed between the charts. What it matters is how much is the price movement that has happened. So what happens is what is important determinant is the box size or tick size. So box size or tick size, it could be better understood by, let's say, the visual representation. So we'll just look at the visuals here. Now this is a typical point and figure chart. You can see it's basically a grid of X's and O's, X and O's, but they have some pattern between this. A new X is marked when the prices are increasing. O is marked when the prices are decreasing. So let's start how this particular box was derived. Let's say the price was 850 or 851 rather. It increases. Now here are, if you can see, the tick size is $1 and it's fixed. So we have this tick size or box size fixed as per the dollar value. In this case, it is $1, but it could be $2 also. It could be 10 cents also, depending upon your volatility. Right? So there's no fixed nature here. It could be any value. It's only dependent on the benchmark that you set for your trade or particular time period. It is $1 now. It can change to $2 if the markets are becoming more volatile. It can change to 50 cents if the markets are becoming less volatile, and the charts will follow. When we change the scale, your box sizes will follow from that moment onward, and we can simply keep marking next to each other, right? Next boxes next to each other. So how the point and figure chart is marked is, let's say your price increases from 850 to $851. So you mark an X. Any movement from 851 up or down, as long as it is between this range 852 to 850, will not trigger any marking here. A new mark, either X and O, will be added only when the dollar movement is more than $1 being our box size. Right? So only when the prices cross this 852 number will we mark another X above it. Similarly, when it crosses 853, we'll mark an X, and that's why it will continue. Now from 855 here, the prices do not go further, but they rather drop. So it drops back down to 854. So this time we move one place to the right, one box to the bottom, and mark an O here. So the price has moved from 855 to 854. And as long as prices keep decreasing, we'll keep marking O's one below the other. So X move up, O's move down. So if I have to show the direction of marking, it would be like this. And it would be evident from this discussion, until and unless there is a reversal, we will continue marking in the same box, even if it becomes a very, very long series in a vertical line like this. Right? It could be multiple boxes, right? Because especially in case of a trending market, we can have a series of X's and O's until we get a reversal or until we get a movement in opposite direction. And even then it could continue. It could be a series of X's, or in this case, let's say series of O's. It continues for a while, it reverses for a while. There are one or two X's, again reverses to downtrend, and again these O's continue from here. So that way it will continue marking, and that is the indication of a trending market. One point we have to keep in mind, that when the trend reverses, when we move from one row to the other, to the right, we always move to the right. We do not mark on the same level, But in case of a downtrend, uptrend changing to downtrend, X changing to O, we leave one box to the side and mark on the box below. In case of downtrend changing to uptrend, O's changing to X, we leave one box here on the down and mark on one box above. Right? So this will continue. And when you see too many X's and O's in a particular given range, you can see that there's a sideways trading happening within a particular bound range. You can see how many times the reversal has happened. It doesn't tell you, one column doesn't indicate it's a 1 day's trading. It's only when the reversal has happened, right? So it could be an indication of a rectangle pattern, right? Remember rectangle pattern, prices keep swinging between a range. So when we see series of X's and O's within a particular price range, it tells us that markets are trending. When we see such long series of long row of X's and O's, it tells us that market is trending in a particular direction, up or down. And when we see it horizontally, almost equal number of X's and O, we know that the market is trending sideways or in a neutral zone, right? So that is the importance of box sizes.